Mira Business FM.
This is Mira Business FM. It's the morning drive. My name's Tim Elliott, and for an hour now, just under an hour, we're going to be talking the fundamentals of financial planning. And this is really the fundamentals of personal financial planning, which involves, I guess, a systematic approach, probably the best way to put it, if you want to achieve financial goals. James Thomas, as I mentioned earlier, is an independent financial consultant. Let's move over to James now. Nice to see you.
And you, how are you?
Very well, thank you. Nice to have you here. Look,
Thank you.
this is a topic that we've talked about many times
It
together. I worked for many years for a personal finance magazine. You were a contributor to that, so this is something you know about. This is how you make your living, offering people advice. Because after all, financial products, like all products, need to be sold to people. The idea needs to be inculcated, and it's something that we have to do. If you can't rely on yourself, who are you going to rely on, James, I suppose?
Exactly. It's very much the point.
It's really as simple as that. So let's get back to basics. What I want to do for the next hour, and I've kind of structured this in a certain way, and I'm hoping to preempt you in some ways, but, trip me up at will. Practical steps for effective financial planning, key financial planning concepts. Let's start there. And then what I want to do is look at a few specific scenarios where you are in life, the kinds of things that you could or perhaps should be doing as well. So that'll be in the second half. The thing is this, at some point, all of us have to sit down and be honest with ourselves from a financial perspective. That's kind of the first port of call. And you mentioned this last week, and I think this is such almost a light bulb, a eureka moment in some ways. But it's that point where you sit down with that blank piece of paper, as you do with a new client, and say, right, what do you want to do? Is that where you start?
Absolutely.
Right.
Only this morning were we having a similar conversation about a particular area of financial planning. But you need to go right back to the beginning, exactly that blank piece of paper, the fact finder, or just a notepad, whatever it is, and actually sit down and think, right, okay, what do I want to achieve? What do I need to do?
Yeah.
And then the questions start flowing from there.
And it really is a case, isn't it, of sitting down and saying, right, if you've got a couple of bank accounts, this is what
Yes.
I've got there. This is what I've got there.
To start with, is a lot of what we would call closed questions. What do you have? Tell me about your bank accounts. Tell me about what you have in place at the moment. Tell me your date of birth. Tell me what your financial situation is. How much do you earn? How much do you spend each month? Now, there again is a whole potential can of worms. And people think they know how much they spend. When you really start to drill down into it, you get a very different figure. A great exercise to do is simply, whether we still do it or not, but rather than saying no to the receipt, every time you spend some money, take the receipt. Have a bowl in your kitchen or wherever, and put all your receipts in there for a month.
Yeah. There's no excuse for it now either, is there? Because every receipt you get, generally speaking, you're going to get a text from the bank saying, I spent what?
Yes, but I would suggest getting that physical piece of paper. When it's a text message, we delete it, we ignore it, we don't look at it. If there's it doesn't have to be a fish bowl, but I just like that idea, the big glass bowl there, and suddenly you see a pile of receipts.
Yeah.
Or to print out your statement at the end of the month and actually do a little audit on yourself and see where that money has been spent.
It's the discipline, isn't it?
It's the discipline, and it's not necessarily to say you should not be buying those things, but it's just actually to make yourself aware of what you really are spending your hard-earned money on.
But in terms of where we are now, what we're talking about today, that's a really good place to start. So, and that forms the basis of some sensible, honest budgeting.
Absolutely.
And that's really, really important if you want to look at exactly where you are. So really the starting point is that blank piece of paper. You analyse what you've got, where you're going, your current situation.
Your current situation, where are you now?
Right.
Because until you have established your situation, it's impossible to move forward because you're just guessing. So to actually accurately work out where you are, what's coming in, what's going out, and then we can start to move forward and start to build a plan.
Okay, so stage one is review income, expenses, debts, assets, to find out exactly where you are, to really understand your situation. Did I miss anything there? Income, expenses, debts, assets. They're the key points. The key point.
Yes.
And to know, and to keep your receipts, get the fish bowl,
Like I say,
put them in there.
maybe
Take the fish out of the bowl first.
Take the fish out of the bowl. They might not appreciate the paper being thrown in, but it's just to get a more accurate picture. Because like I say, people might say, I earn X, I spend Y, the difference, therefore Z. When you start to look more accurately at it, those numbers, while the income, most people know what they earn, but again, that is not always taken for granted. Once you start to look into what they really do earn, bonuses, dividends, other incomes that they may receive, versus what their expenditure really is.
And of course, liabilities that people may have. There could
liabilities,
be
indeed.
Car loan, credit card debt, whatever it might be in there.
Yes.
I want to come to that later because I think that's a very important topic to cover. So you've done that. You've analysed your current financial situation. The piece of paper is no longer a blank piece of paper.
Very much not. It'd be a lot of information.
Right. So this is whether you do this with an independent financial advisor, consultant, such as somebody like you, James, or you do this yourself and you take this this is your own responsibility. Next step, and I'm wondering if this is the right thing, but to me it makes sense, setting a goal. Is that the next thing you should do?
Potentially. I'm hesitant to say yes, because I think you may be jumping ahead a step or two, because then it's a question to, which is where I think the value that speaking to someone like myself comes in, is actually looking at that, effectively a series of data points, but already you can start to look at what might be areas that need this further discussion.
Okay.
And then we move on to actually putting some action points in place. For example, do you have children? So then that opens a whole discussion potentially about their education requirements, the cost of that. It then opens discussions.
Cost of their training shoes as well.
Yep.
Yeah, sneakers are
expensive.
Yeah.
Although I'm told there are particular sneakers that are actually worth.
Well, if you could point me in the direction of those said sneakers, I'd be very
I suspect they need to stay in their box and not be worn, which kind of defeats the object. But anyway, yes, and then obviously related to that, not just for their future, but actually, again, and it's not a particularly nice topic, but one that is absolutely essential, is what would happen if you were no longer there for their future.
Okay.
So life insurance, critical illness, things that we hope won't happen, but sadly, as we've experienced, do.
Unfortunately, things like that do, and medical issues or losses in the family, etc. Okay, so really that is planning.
So that's the planning. So that's where the discussions will open up from. So you've got that data, you've got a much better idea of your current situation. It's then to start to explore the areas that would need further advice and planning.
Okay, so 1, analyse current financial situation. 2, create a plan, outline a path towards a financial goal, strategies to get there, to achieve them, and a timeline to kind of implement. And I think, would it be reasonable to put forward a suggestion that, this is a time to start to not put yourself under pressure, that's the wrong term to use, but to put the onus on making sure that you do this.
Yes.
Because it's something that we kind of run away from.
It is. And as we discussed last week, with the those structured notes that had
that's right.
caused some issues.
Yeah.
It's not to be hard sales and it's not to be pushy, but equally it's to realise that these things are important and should be addressed. So therefore, to put that strategy in place and really start to implement things so that you actually do make sure that you have a good financial plan in place.
Yeah, and it's really to get across the importance of financial planning, because it's a very easy thing to imagine. What if you haven't got any money? What if you can't get the taxi to get to work? What if you can't put petrol in the car? Those things. If you imagine a scenario like that and you haven't planned for it, that's really oversimplified.
Well, the irony is that is retirement if you have not planned.
Well, exactly.
It's something that we often talk about with our clients and prospects. what would happen if you couldn't work for a week? Oh, no problem. Potentially, you would think no problem. What would happen if you couldn't work for a month? What would happen if you could not work for a year?
Yeah.
And then the last is obviously, what if you never worked again?
And there we are back right at the start. Be honest with yourself. Really think it through.
Yes. Now, some of these questions are so out there, especially if you're 25 years old and I'm saying to you, you're never going to work again. That might be 40 years in the future. But nonetheless, that is what is going to happen at some point. I know things here are becoming more relaxed, but when I arrived 20 years ago, it was age 60, was when you were issued your last visa. If you're lucky, you may get another year or two. And then it was really, you had to move on to somewhere else. Now, like I say, with golden visas and retirement visas, it is more flexible now.
Yeah.
But nonetheless, most people will return to their home country or another country after they finish their working career here. So it's making that plan for that eventuality. Now, at 25, I would suggest you're very unlikely to know where that future place is. But if you haven't made a plan to make sure that there is sufficient funds to provide for that, it makes it a very difficult discussion to have, because what we do know is that time goes by incredibly quickly.
That much we learn as we get older. I have noticed that. So a wise man once said to me, fail to plan, plan to fail.
Exactly.
Okay.
Yes.
So analyze your current financial situation. You've got the piece of paper. It's rapidly filling up here. There's a lot of information there, as you point out, James. Create a plan. Do we next look at budgeting, checking spending, creating a budget there? Is that the next thing to do?
Yes, I would suggest so. Because again, going back to that analogy of where to retire, it's all well and good saying I want to retire on X thousand pounds, dirhams, dollars per month. But if at the moment there isn't sufficient earnings to fund that, then it's then having a sensible discussion as how we get to that point. One would expect as we work through our career, our earnings would increase. But also when you've got the benefit of time, the savings that you have to make are obviously much, much reduced, because you have the benefit of the long future ahead of you before that date arrives.
I'd also kind of put forward that I think a lot of people spend more than they earn. And this will lead us to the credit card conversation, the loan conversation in a moment or two, or really don't have a handle on overspending month to month. And that's something that I guess an exercise like this helps you get a handle on.
Absolutely. Even before getting into that, the most long-term of planning retirement, yes, absolutely. Is once you've done that analysis and the amount of, it's worked both ways. Some people are amazed that they're actually way under budget, but unfortunately, lots of people realise they are spending way more than they thought they were, and therefore this exercise allows them to really get to grips with what they're spending their money on. And therefore can start to make a plan to be more sensible with their budgeting. Do they need that coffee every morning? Or rather, let me rephrase that. They may need the coffee, but do they have to buy it? Or can they actually go and buy some nice beans themselves, make some coffee at home, take it to work, rather than stopping at the coffee shop, paying probably 10 times the price? Again, it is that classic, yes, it's not much money, but once you do that every day, every week, every month, and that's just one very small example, but there are many other ways that suddenly you can really make some significant savings to your budget or your expenditure.
You see, I think that's an interesting point, because I think generationally now, perhaps the older generation looks at the younger generation and thinks all you do is buy cappuccinos and eat avocado on toast.
Absolutely. That's exactly what came to my mind, and I really don't like that, because
it's unfair.
It is unfair, but it's an easy example to use.
Yes, yeah.
There are other expenditure that of a similar ilk that can be very easily reduced. Cook for yourself, dare I say. Buy.
You might enjoy it.
If you're eating, yes, make it part of your day. And again, when you see what you're spending on eating out, if it's every single meal versus buying some groceries, cooking for yourself.
It's not the most cost-effective way to do it.
It's not the most cost-effective. And just what I'm trying to highlight is that a few small changes in various aspects of your expenditure can make an enormous difference to what you have left at the end of the month.
It's that relationship between essentials, the things you really need, the weekly shop, the petrol for the car, whatever it is, and discretionary purchases. And I'm not talking about, buying the latest gadget or anything else. It's, do you really need to have that, additional, I know I'm pointing in the same direction as you, that cup of coffee again, but to understand what's essential and what's discretionary is the key, isn't it?
It is. That's exactly it.
Yeah, okay.
And just to have that thought before you do tap your card. And again, in this day and age when it is, you haven't actually even got to go to a cash machine, withdraw some money. Again, I'm sounding like such an old, but when we arrived...
You don't look old, don't worry.
When we arrived, everything was cash, wasn't it? Now, it's very little is paid for with cash, rightly or wrongly. But that process of just tapping your card, you don't have that physical...
There is no physical exchange.
You don't see the cash come out of a cash machine into your wallet or purse and then actually be spent and then see it empty again. Yeah. It's simply, we're not even getting a card out now, is it? I'm told, again, it's a sign of old age when you have a wallet, when you should just do it all on your phone, tap. But even, again, it's...
Even my father pays. He's 82. He pays with an Apple Watch wherever he goes.
There you go.
I mean, it's spread across. But the point is, I know exactly what you mean, and it's a very hard thing to define. The idea that you're not parting with physical notes or coins, there's a disconnect between what's in the bank account, isn't it?
Yes.
Okay, when you use a card. So it's something to
It's just, again,
think about.
It's exactly that, to think about it, be aware of, have more ownership of where your money at the end of the day. This is your hard-earned money. Where is it going? What are you spending it on? And are you enjoying what you're spending that money on? If the answer is yes, then fine.
Yeah.
But it's just to take a little pause and think, where has that gone? Because if at the end of the month you're finding, as you rightly say, that you're then leaning on your credit card or having personal loans, which are a great short-term win, but they need to be repaid. Yeah. And just to keep, as I say, just take that a little bit more awareness of where your money is going.
Yeah. And to be fair, the way that you put that across is thoughtful. And I think that's interesting, because if we were more thoughtful when we were spending and we were prioritizing purchases that are important to us, whether they're essential or discretionary, the things that are important to us, what you're saying is fine.
Yes.
As long as you're thinking.
It's thinking about it, just having that thought process. Like I say, I'm not here to say you mustn't buy that, you mustn't buy the other. If you do want that coffee, then fine. But just have that thought process behind it before you just simply thoughtlessly tap your phone, your card, and not realise or put the connection that that's your money that you're spending.
Yeah. No, absolutely. That's really interesting. So be on top of your money. Don't let your money be on top of you. I learned that years ago. Fortunately, but it was a painful lesson. Credit card, oh, great, this is free money. Of course, it's not free money. I took ages to pay credit card debt back, and I now live in my kind of ethos now is, if I spend on my card, I pay it back. I pay it back in full.
I mean, again, it's one of those things. I mean, when one of the first things that you're offered when you go to university, and I'm sure at college or wherever it might be, is a credit card. And the amount of people that then were given what were at the time a relatively low credit limit, but straight away they'd be at their maximum, and then having to pay literally the minimum amount and just servicing the interest. And no one had explained to them, now maybe you should be aware, but again, this is part of the educational process that I like to think that we had, is making people aware. And as you quite rightly say, a credit card is a very powerful tool if it's used correctly. But if it's repaid every month,
See, this is the thing. I think people look at credit cards a number of ways. I look at credit cards. I think they're great. I think they're fantastic things, really useful. Very often online you get a better deal because you may get, some form of insurance, payment insurance. You may get access to lounges with airlines, whatever it is.
All sorts of benefits that come
Huge
with
benefits. But if you're not aware that
there's a potential price to pay if you do not keep on top of what you're spending on that card.
Yeah. The other thing, and I don't know what you think about this. I don't know if this is never really something that's talked about. Is I always feel I don't enjoy being in debt. I don't like the pressure. And maybe this is just a personal thing. I don't like the additional stress. I don't think that's particularly a personal thing, but this is very much a personal experience. I'm debt-free, actually, I have to say, and I'm fortunate in that way, but it's taken a long time to get there. But I know that when I pay the credit card back, I get a good feeling paying it. If I get a bill that comes in, I pay it online straight away, not because I'm rich, because I'm not. I'm not a wealthy person, I'm fine, but I don't want the pressure, and I feel better.
Absolutely. Well, again, it's twofold, isn't it? The discipline of making sure everything is paid. But I 100% agree. That feeling when the credit card balance is zero, when DWAR is paid and you get the text message saying that's done your Etisalat or due, I think it's a great feeling. And it's one that people should embrace. Again, you've paid your debts. You're free. The rest of that money is then yours.
Yeah,
which is perhaps the point we're going to come to, is then paying yourself first.
Well,
using that money, that's your money. So therefore, don't be entrapped by the debt and liabilities that you've accumulated.
Yes.
Actually flip it on its head. Make sure that you're in control of your money and your finances, so that when there is money left in the bank account, that's yours. And like I say, whatever your hobby might be, whatever your enjoyment is, don't feel guilty of spending that money on that. If it's a thoughtful purchase, not just a throwaway tap, and suddenly there's a big chunk of your surplus income gone. It's, to me, it's just a shame, dare I say. It's just not a good use of your hard-earned money.
You're showing some passion, Mr. Thomas, I have to tell you. But I am with you, and I think it's really interesting that we both kind of think the same way. There is a feeling, and the better you feel, the better you're going to do, and that all contributes to, I guess, personal wellness, which is a good thing. I want to come to paying yourself first in a moment, because I think that's a really important concept, and that's quite I don't want to use the term empowering, but it is kind of empowering. It's a freeing kind of feeling.
It is.
First of all, though, if you do have credit card debt or high interest debt in some way.
So yes, going back to that fact find, that analysis, the initial review of your current situation, if you find that you do have liabilities, then we need to rank those in order of the level of interest that they're accumulating.
Okay.
Now, typically, credit cards, unsecured debt will have the highest rate of interest, followed by personal loans, typically, and then finally, mortgage debt will generally have the lowest level of interest. Why? Because it's secured against the property.
Yeah.
So, first principles, pay off the debt that has the highest level of interest, because that is what is accumulating at the quickest rate. Generally, a property will be a much longer term, but that is usually your home, or maybe it's an investment. But nonetheless, even if it's an investment, rather the rental income that it's generating, if it's set up correctly, should be servicing that debt. If it's not, again, that's another discussion to have as to why do you have that investment? Again, there might be reasons behind that. But yes, as a first principle rule, pay off the highest debt first, make sure that that's paid down, and then you're freeing up more capital for yourself.
Absolutely. And if you have a couple of credit cards and a car loan or, debt that is weighing you down, talk to the lender, talk to your bank.
Absolutely. If you're finding you are struggling, yes, talk to them before you get to the point of default.
Yeah.
Because that's often very hard to come back from.
But there are ways of restructuring.
There are ways to restructure, but absolutely. But again, these things need to be spoken about. You need to take your head out of the sand, to use that analogy.
Yeah, yeah.
If you just leave it until the point of no return, it's much, much more difficult to find a path out of that situation.
So be honest, and you can sort yourself out, and then you will be able to move forward. That really is the point. Okay, we're going to take a break. We're talking to James Thomas. He's an independent financial consultant here on The Morning Drive. We're talking about the fundamentals of financial planning and a concept in a few moments called, known as Pay Yourself First, PYF, not Pretty Young Thing, not a Michael Jackson song, but we're going to come back and talk about, try to break that down here on Mira Business FM. Next.
Mira Business FM. Mira Business FM.
It's The Morning Drive. I'm Tim Elliott. This is Mira Business FM. And we're talking personal finance. Just a reminder, you can listen live on our website. Maybe that's where you are at the moment, mirabusiness.fm. Everything we do is there. Watch, listen on YouTube, Twitch. We are live. Plus, you can catch up on any interviews you might have missed. Find us on X for News, Instagram for Shorts, and on LinkedIn if you'd like to know anything more about our guests. Plus, wherever you find your podcast, the usual story. Subscribe, let us know how you feel about the content that we make. Now, this morning, in this hour, we've been talking about the financial planning fundamentals that we all really should know right now. It's a systematic approach that we need to take to managing our finances, that much I've learned. Budgeting, saving, investing, risk management to achieve your financial goals is some of the topics that we'll cover. So far, analyze your financial situation, your current financial situation. Be honest, that's where you start with that blank piece of paper. That will then fill, create a plan, learn to budget, check your spending, prioritizing purchases that are, I guess, most important to you, whether they're discretionary or essential. We've talked about paying down high interest, credit card debt as an example, perhaps a car loan that you might have. James Thomas is here. He's an independent financial consultant. James, I was just thinking in the break there slightly more about debt and how people handle debt. I find it very hard to handle financial pressure. I don't like it. I guess that's the same with a lot of people, and I kind of want rid of it as much as I can. But you've obviously talked to people in your career who have faced debt issues, whether it's credit card debt or others. What do you need to do if debt is getting you down? Because it can have a serious effect on a person's financial health, on their well-being, on their relationships, etc. And of course, you know, if you are in debt, it does prevent you managing money properly.
Yes, absolutely. It is one of the most serious parts of financial planning. If you're in debt, it really can affect you in all the areas you've just described. What I would say, as we said before the break, is to try and not wait until it is unmanageable.
Back to the honesty.
Back to the honesty part, absolutely. So if it is credit card debts, can it be converted into a personal loan? Not that I'm a huge fan of that, but typically the loans will have a lower interest rate. It can then be consolidated. It can then be structured into a monthly payment that is hopefully then more affordable, and then you can see the debt dropping. And then also you've got a known payment, going back to the budgeting, so you can actually make a plan that I know I need to spend X amount to service that debt. Yes, it may take a few years to get that under control, but nonetheless, there's then a plan in place to reduce that. But it's, as I say, it's that honesty, it's taking control. It's not letting it run away from you.
Yeah, and that's really the key, isn't it? It's facing the issue head on.
Facing the issue head on and getting on the front foot. Okay.
Here we are at Pay Yourself First, which is a long-established, I guess, principle more than anything else, not just an acronym, PYF. And it is, I guess, the theory that You are paid at the end of the month, assuming you're employed, or you get a salary of some description, and you pay your bills, and you pay any loans that you may have, you pay any liabilities that might arise, and then you decide, right, I'm going to pay myself, and that forms the basis of your savings. The rest is my money. Is that reasonable?
Yes.
But kind of how it works.
Exactly how it works. But I think, again, if people do not think to that degree, at the end of the month, X dirhams comes into your bank account, and it's not really then considered where that money is going to go. It just happens over the course of the month. Various bills will come along, various other expenditures. That money gets paid out, and you then perhaps go on holiday or plan for a holiday. You maybe go for a night out or two. Suddenly, at the end of the month, the money's all gone. You know, it's just that. It just disappears into the ether.
Money's like that.
If you're not careful, yes.
Yeah.
Or like the tap, it runs down the sink, through the plug hole, disappears.
Yeah.
So the principle of pay yourself first is actually, again, through the process of the planning, is to say, right, this amount is coming in. Let's make sure that I'm doing something with a proportion of that money. Now, I use the example of a British national because the tax situation is very easy to understand. If you're a basic rate taxpayer, the government will take 20%. If you're a higher rate taxpayer, it's 40%. There is a threshold above, but let's worry about the 20 and the 40%. A principle that I've often used is to say, but if you're a higher rate taxpayer back in the UK, take 20% of your salary and put it aside. So you've still given yourself a 20% pay rise, if you want to call it that, an allowance, but you're taking a significant chunk of your salary and paying it to yourself first, and actually making a conscious effort to do something with that money. And again, another cheesy line is to make sure that when you eventually leave the UAE, you've got more than memories. You've actually got a lump of cash in whatever form that takes, and that's the next part of the conversation, to take home with you.
That's interesting. I mean, this is assuming expatriate tax planning, but I think the principles of financial planning apply across the board. These are universal.
These are universal.
Ideas,
I use the example of the British national because
tax
that's
reasons, sure.
just from the tax, but most European countries, and most countries other than the UAE, have a similar structure that if you earn a salary, you are taxed. The rates and the thresholds and the amounts might be slightly different, but the principle is still the same. You earn money, part of that will be payable to the government of that country in tax. The huge benefit why many of us come here, it's not the only reason, but it is a great benefit, is that the salary that you earn is paid to you.
Yeah, okay. So pay yourself first. So put that amount, that percentage, however you work that out aside, pay your bills, and then the rest of your money is your money. And if you do that consistently, you begin to build funds, okay? Now, there is another, and I think this is a really important part of personal financial planning because it relates back again to trying to take the stress away.
Yes, and I know where you're leading to. It's absolutely built. The first part of that savings plan is to build a cash reserve, a buffer. 3 to 6 months' salary typically is what we would normally recommend, just so that that unexpected bill, the washing machine breaks, the car breaks, whatever it might be, that unexpected bill, suddenly it's not a problem. You've got a nice pot of cash that you can simply pay whatever it might be from that money and not have to worry.
The great thing about that is it doesn't derail other plans you may have for your money as well. And as long as you take the view that, okay, I do have that buffer there, that's what this is for, I can use it for this, and then you take steps to replenish.
So it's not to be the place where you pay the monthly bills, the DIWA, etc. from. It's for those unexpected, and it's just an amount that's sitting there. Now, some people may say, well, that's not working very hard for me, but that's a further discussion. But I would always argue the flip side of that, again, is that peace of mind, knowing that should something come along unexpectedly, immediately accessible, pot of cash to pay whatever it might be.
Okay, and that's over and above any savings you may be intending to position in an account.
Absolutely. So my view would be you build that 3 to 6 months buffer. Once you've got there, then we can start to talk about building a longer term strategy. So that may be, again, pension replacement, lump sum, regular savings, actually taking that money and moving into a vehicle that's outside of your bank account arrangements that can be invested into, again, funds that we will discuss. And by funds, we mean investing into stock markets. And again, that's a whole different discussion. But the principle is that you start to move that money aside and actually building a pot of cash above and beyond what the emergency fund is.
So you have addressed any debt issues you may have. You have a plan in place. You have your buffer of 3 to 6 months in cash, ready to be used. You have some savings, and you're earning regularly. Let's assume that as a basic situation. The next step, I guess, is investing. And that is, as you say, that is a different issue, and that entails understanding the risk you would or are comfortable with, the reward that you expect based on that risk, but also understanding different investment vehicles, the way they work, whether that, again, is you taking that burden upon yourself or working with a financial advisor.
Yes, absolutely. So as you've just said there, the key principle is do you want to do it yourself? Do you feel comfortable? Do you know? More and more people do have many ideas of what they want to invest into. But I would always add an element of caution just to talk through those ideas. Are they the right solutions for what you're trying to achieve? Yeah. Are they long-term, regular income or growth-producing assets? Or are they slightly more adventurous, shall we say? Particular asset classes I can think of that have produced some amazing returns, but also can produce some pretty frightening losses. Yeah. And that's when we get onto that discussion of risk versus reward. Yeah. And I've showed you before that the pyramid, the table at the very bottom is cash. Yep. Relatively, I'm hesitant to say no risk, because over the longer term, it does have a guaranteed risk. That risk is that it's not going to grow in line with inflation. Right. So if you have a large amount of money, cash is potentially the worst place to leave it long term.
Because you don't get the interest.
Because even if it does earn interest, the interest is likely to be below the level of the real rate of growth or inflation. Right. So it's going backwards.
Okay, I'm with you.
In our world, the other end of the scale would be direct equities, direct shares. Yep. So picking a particular company that you feel very passionate about, that you believe is going to generate a huge rate of return. And if I'm allowed to use examples, NVIDIA would be a great example over the last few years. Amazing numbers. But one, is that going to continue? I think if it's not the world's biggest, most valuable company, it's certainly one of the top 5. It may be that that's going to continue. But to now double in value, it's got to grow to be twice the size of almost its nearest competitor. Yeah. So then the question is, what is the next NVIDIA? Yep. And that's the risk.
Absolutely.
If you hit the jackpot or the bullseye, you're going to see some amazing levels of return. But for every company that generates the returns like that, there will be many, many more that disappear without a trace.
The point is, with this segment of financial planning, this is kind of the next level, isn't it? The investment segment. This requires research, it requires work, and that needs to be constant.
Yes.
Because the business world these days has always been dynamic, these days exponentially dynamic.
Yes.
Okay.
So the area between that cash and the direct shares is where typically mutual funds, unit trusts, OICs was a great name, open-ended investment companies. These are collective investments.
Right.
But by that I mean there is a fund manager or team of fund managers who sit there and their full-time job is simply to select individual equities to sit within that portfolio.
Right.
So that's all they do. And they will then have different ideas of what they're trying to achieve. Are they looking for growth? Are they looking for income? Are they trying to invest in particular segments of the market? And that's all they will focus on. So that's why we typically will recommend that sort of asset class, because even though I follow the market probably more closely than most, I don't have the time, because when I'm sitting down talking to my clients, I'm not following what's going on. I'm not trading. I'm not looking to buy and sell on a daily basis. Our strategy is typically to buy and hold.
Right.
And all of those other transactions are going on within that fund. We hand over that responsibility to those professionals whose sole job it is to do that on our clients' behalf.
And you need to be aware of that. You need to be aware that there is a fee involved in that, of course.
There is a fee, yes.
There is a relative kind of comfort level. But again, that is next stage investing. That's the point that that's kind of our cut-off point, if we're honest, for this particular segment, because that's the point at which specialized knowledge comes in, and we need to be looking at, what is a stock, what is a bond, what is a mutual fund, what are these investment vehicles, how do they work, and there's probably an hour in just what a mutual fund
Easily.
is.
Yes.
So this is the point that I guess we'll kind of park it there, but that's where you're aiming to get.
That's where you're aiming to get to. This is the longer term investment planning.
Right. Okay.
So this is once you've sorted out your current situation, you've worked out where your money's going, you've built your nest egg, your emergency fund, then that's where you step onto as the next point of discussion.
So you consider your risk versus reward kind of appetite for that. You look at the mix of investments, because obviously you don't put everything in the one place. You want to have a spread in most cases. And if that's aligned to your time frame for investing, your financial needs, your comfort with risk, then you would move on from there. But it's not for us to tell people what to do with that, but that's kind of
But they've highlighted, absolutely. So there's many, many areas that need to be discussed and reviewed, because it is such an important part of one's financial plan.
Yeah, and risk management is another whole discussion, or 10, I'm thinking. But we've got 5 or 10 minutes left, and what I wanted to do was to give you a few scenarios, okay? You've decided where to begin, you know where you are in life, you've made the decision, you're going to take the step, here you go, you're about to dive in. You've weighed up the risk and reward, but what do you need to do? What's absolutely non-negotiable? Would you take into consideration that piece of paper, the things that you have, the things that you're looking to do, the plan that you have, life cover, savings plans, mutual funds, market exposure. Let's put all of those to one side for a minute. I'm going to give you, how many scenarios have I got? I've got 4. Okay. Here we go. Scenario number 1. A young, unmarried, single, fresh graduate, 22, 23 years old, starting out on a career, may have first job, first foot on the ladder. What should somebody at that point in their life be thinking about financially?
Again, educating themselves,
Okay.
because they're right at the beginning of their journey.
Mm-hmm.
So the more information and the more knowledge you have, the better.
Okay.
As to practical things, we haven't gone into a huge depth this morning, but life insurance will never be cheaper.
Okay.
And as boring and as perhaps unnecessary at that point, if they were to simply take out some life insurance, it would never be more cost effective for them.
Mm-hmm.
Because in the future, when they potentially do then get married, have children, the cost of that life cover and that protection would only be more expensive. So even if it's not necessary then, there is an argument to consider putting something in place because the premium will be, relatively speaking, pennies.
Okay.
So that would be an aside conversation. Then it's building that lump sum, that cash reserve, that emergency fund, and then some form of savings.
Okay.
To start getting into the habit. Because again, like all things, once you're into the mindset that every month I pay myself something, be that a few percent or many more percent, depending on what your budgetary allows you to do, it's the habit, it's the key. And again, much like the life insurance, if you've got that runway of, if you're fresh out of university, you're 21, 22, 25, you've got a 40-year term ahead of you, which in some people is frightening, but actually flip that on its head and use that to your advantage. You have time, so take full advantage of it.
Okay. Scenario 2. Young, married, professional, 30-ish. I mean, these are just scenarios.
Yep.
I'm not pointing in any particular direction, but let's imagine young, married, professional, 30-ish, one child, small child, young toddler, baby perhaps, and one on the way. What should a person like that
Again,
be
that's
thinking
when
or a couple even?
That life insurance becomes, and arguably critical illness cover, but certainly the protection becomes even more
There's a stronger
pertinent.
case, is there not, for life insurance for somebody in this situation than there is for the young?
Very much so. But why I just highlighted it before, we're now
For price reasons. Okay.
5-10 years further on,
Yeah.
the premium will be higher.
Okay.
It's just a fact of life.
Okay.
But then it's then starting to think, again, the retirement planning is still there, but then it's university or school fees planning. Here, you will have to pay for your child's education. You may be lucky that your company assists you with that. But I always say, well, make sure that you've made that provision so that if you change jobs, your company changes its terms and conditions, you have put a plan in place that you can still cover those costs.
Okay. Okay. What's the difference between scenario 2 and scenario 3? And I'll ask you this for a very specific reason, in terms of professional experience, I guess, but more on that cost. Young, married, professional, 31, baby, one on the way. Scenario 2. Scenario 3, slightly older, maybe late 30s, early 40s, self-employed, married, professional, company owner, perhaps. Could be a slightly more high-flying executive by that point, who knows? But 2 children, say, in secondary school, nearly finishing secondary school. What's the difference between those 2 scenarios? Is there anything major?
Major, no. Only that probably the education expenditure coming up is university, which is likely to be more expensive again.
Oh, yeah. Oh, yeah, it is.
Yep.
As I found out.
And then if they're talking of maybe US colleges or other countries, UK as a foreign student, there's many more expenditure that has to be factored in. So it's not so much that the scenario is particularly different, but the numbers are likely to be higher.
Okay. I kind of thought that was the way you were going to go. Last scenario is something, is kind of, I suppose it's a natural extension, the next stage in life, really. But let's assume, for the purposes of this, married, 50s, wants to do something for themselves. Maybe the kids have been through university, flown the nest. What happens then? Because that's a very different situation, isn't it?
It is. Again, life cover becomes less important. I'm not going to say not important, but why do we take out life cover? Is to protect either a liability or a potential future liability that could be presented. So if the university or school fees have been covered, then that's gone. And it's also, you would hope by that point you've built sufficient cash reserves of your own that, again, it sounds very crude, but it's not meant to be. If you were to die at that age, what would the financial implications be?
Yes. Yeah.
So therefore, by that stage in your life, it may well be, from a financial point of view, there are no implications. There's obviously the emotional and everything else.
Sure.
That will always be the same. But from a financial point of view, the life insurance becomes less important.
Do you know, that's a really interesting point, the way you said that there. You do need to be able, this is an incredibly hard thing to do, but you do need to be able to kind of divorce the financial implications and the way you look at those financial implications from the emotional
Very
situation.
much so. The emotion's always going to be there, but from a financial planning point of view, potentially very different. And it's key to be able to separate those two issues. But from that 50-year-old, potentially would be retirement. That's very much now, rather than that 40-year runway, that's probably a 10-year timescale.
Sure.
So is sufficient provision in place? Are they looking to retire somewhere else in the world? Do they want to buy a property in that location? Do they have enough money accumulated? If not, then that needs to be very much the focus of building that cash reserve. Now the children are gone, flown the nest, the monies that were being used for education, pump that into your savings, your retirement plan. Really maximise the years you have left working, that you want to work, that you feel that you have the energy to work, and build that retirement fund.
I mean, every situation is different. And these are just examples. These are just the fundamentals.
The fundamentals. Obviously. And when you sit down, when you've got that fact find, that piece of paper, every situation will be different.
Yeah. I really thought we could cover probably most of the topics here, but I have a million questions, which means, James, you're going to have to come back. There is an awful lot more to talk about. But I think, and I hope, the fundamentals of financial planning, that's of some information, some kind of use to people. James Thomas is an independent financial consultant with me here on Mira Business FM this morning. Huge thank you.
Thank you.
Appreciate you coming in. Mira Business FM. That's the fundamentals of financial planning.
Mira